All right, let's dive right in. Today, we're talking about a really powerful tax planning tool for Canadian couples, the Spousal RRSP. If you're in a situation where one partner earns significantly more than the other, have you ever wondered if there's a smarter way to save for retirement? A way to boost your partner's savings and actually lower your family's overall tax bill? Well, that's exactly what we're going to unpack. My name is Samir Al-Rishani, and in this explainer, we're going to break this whole thing down, piece by piece. So, here's our game plan. We'll kick things off with the fundamentals, what a spousal RSP even is. Then we'll get into the real goal here, income splitting. From there, we'll jump into a practical case study to see how it works in the real world. That's going to lead us straight to the most important detail of all, the attribution rule. And finally, we'll tie it all together so you can see how this might fit into your own long-term strategy. Sound good? Let's get to it. Okay, so first things first, what exactly is a spousal RRSP? And more importantly, what makes it so special compared to the regular RRSP that you probably already know about? Well, it all starts by trying to solve a really common financial puzzle. When you have one person in a relationship earning a high income and the other earning less, how do you set up your retirement savings so you can keep more of your hard-earned money and give less of it to the government? That is the exact problem the spousal RRSP was designed to fix. So, here's the basic mechanics of it. One person, we'll call them the contributor, puts money into an RRSP that is legally in their partner's name. They're called the annuitant. Now, here's the key part, the twist. The contributor, who's usually the higher earner, is the one who gets the immediate tax deduction on their own tax return. Let's just put this side by side to make it super clear. With a regular RRSP, it's simple. You contribute to your own plan. You're the contributor, you're the annuitant, it's all you. But with a spousal RRSP, you're still the one putting the money in and getting the tax break, but the account itself, that belongs to your spouse. The money is legally theirs, with the idea that they'll be the one to withdraw it down the road. Okay, so why would you even bother with this setup? What's the point? Well, it all boils down to one incredibly powerful financial strategy: income splitting. To really see this in action, let's invent a couple. Let's meet Parm, who's a high-income earner, and their partner, CLP, who has a much lower income. This kind of income gap is the classic textbook case where a spousal RRSP can be a total game changer. Now let's just imagine for a second that Parm only saves in their own regular RRSP. Fast forward to retirement. Parm still got a good income flowing in from other things, maybe rental properties or investments. When they start to withdraw from that massive RRSP they built up, all of that money just gets piled right on top of their other income, pushing them into an even higher tax bracket. The result? A seriously painful tax bill. And this chart shows the brilliant solution. Instead of all that retirement money flowing to Parm and getting taxed at a super high rate, what if Parm had been contributing to a spousal plan for CLP all those years? See, now in retirement, the income is drawn by two different people, and because of Canada's progressive tax system, two smaller incomes are taxed way, way less than one giant income. The family's total tax bill drops a lot. That right there is the magic of income splitting. All right, the theory's great, but the real power here is in the details. So let's roll up our sleeves and walk through a proper case study with real numbers and dates to see exactly how this plays out. So let's meet our new couple, Janet and Bill. In this scenario, Bill is the higher income earner, so he's our contributor. And for years, he's been putting money into a spousal RRSP that's owned by Janet, our annuitant. Now, let's look at the history of this account. Every date here is important. You can see Bill made a big contribution way back in 20XO. He then topped it up a little in 20X6 and 20X7. Then we have the main event. January 20X9, Janet withdraws $20,000. And pay really close attention to this last part. Just a few months after she took money out, Bill puts another $10,000. All these little details are about to become very important. So the action all centers on this $20,000 withdrawal that Janet made. And as you know, anytime money comes out of an RRSP, the Canada Revenue Agency gets very interested. Somebody has to claim that money as income and, of course, pay tax on it. And that brings us to the big question. Who pays the tax? Is it Janet, since it's her account and she's the one who took out the cash? Or is it Bill, because he's the one who put the money in to begin with? Well, the answer isn't quite so simple, and it's all governed by a very specific rule. The answer to our question lies in a critical piece of tax law called the attribution rule. You can think of this rule as the gatekeeper for the whole spousal RSP strategy. Understanding it is absolutely key to using this tool the right way and avoiding a nasty tax surprise. So what is this rule? Well, it's basically designed to stop people from gaming the system. To prevent someone from making a big contribution, getting a huge tax deduction, and then having their spouse pull the money out a few months later. The rule says that when a withdrawal is made, the government looks back at any contributions made in the year of the withdrawal, plus the 2 full calendar years before that. So it's a 3-year window. Any money that was contributed in that window gets attributed back or taxed back to the original contributor. So how do we apply this to Bill and Janet? It's actually a simple 5-step process. First, what year was the withdrawal? 20x9. Second, what's our 3-year window? That would be the current year, 20x9, and the 2 before it, 20x8 and 20x7. Third, we just add up all the money Bill put in during that window. Fourth, that total amount gets taxed to Bill. And fifth, whatever's left over from the withdrawal, that gets taxed to Janet. And here's how the numbers actually work out. We look inside our window, 20x7, x8, and x9. Did Bill contribute? Yep, he put in $10,000 in 20x9 after the withdrawal and $1,000 in 27. Both fall inside our window, so that adds up to $11,000. That means the first $11,000 of the $20,000 withdrawal is attributed back to Bill. He has to include it on his tax return. The rest of it, the remaining $9,000, that's taxed as Janet's income. And notice that big $20,000 contribution from way back in 20x0, it's totally safe because it's well outside our 3-year window. Okay, so we've been deep in the details, right? The rules, the dates, the mechanics. Let's zoom back out and think about the big picture. How do you actually use this information to build a smarter, long-term plan for your family? It's always good to circle back to the fundamentals. The RRSP itself, in any form, is just a fantastic tool for building wealth. It lets your money grow without being taxed every year, and as we've just seen, the spousal version adds this whole other layer of strategic planning on top. So if you only remember a few things today, let it be these. 1. The spousal RRSP is an incredible tool for income splitting. 2. When done right, it absolutely lowers your family's total tax bill in retirement. 3. That 3-year attribution rule is non-negotiable. You have to respect it. And that leads to number 4. Planning is everything. To make this work, the contributor has to stop making payments for at least 2 full calendar years before any money is taken out. And I'll just leave you with this final thought. Now that you see how all the pieces fit together, the contributions, the tax deductions, the withdrawals, and the rules, take a moment and think about your own family situation. How could strategically shifting some of that future retirement income from one spouse to the other help you reach your financial goals? Thanks for joining me.